What is going on, investors? Hopefully you guys had a great week, had a jammed pack week of price action and certainly earnings as well. And what I wanted to do was put another consolidated video together where we just go through a bunch of companies in one video. I'll have timestamps in the description and the first comment below. All the links to all the companies that we'll have on today's show. We'll obviously go through the numbers, we'll go through a little bit of news, and then we'll go to the price chart like we normally do here on the channel. Most of these companies were suggested by you, the viewer, so I want to thank you, and I'm going to get to as many as I possibly can today. If you do me a favor, if you like this video, hit that like button and consider subscribing to the channel. I've also included in the description below links to my social media feeds at Twitter and Instagram if you want to follow me on there. I'd love to see you on there. So let's kick things off right now with MGM Resorts International, better known as MGM, owners of my favorite properties in Las Vegas, Aria, really the Aria and the Vidara, really just beautiful properties and super fun to be at. So I'm a little biased towards MGM. I think I got a couple shares of this company. Now, over the last year, this stock has been on fire. 1 year return, 31%. But look, back in March, this stock was like at $7 and now it's at $37 and climbing. Some of the reasons for that is Caesars tipped that convention demand is picking up. Now, if you're not familiar with Las Vegas, not a place that you frequent, a lot. Convention is like the key to Las Vegas because they bring in lots of people and those people gamble. They spend a lot of money on food and they spend a lot of money on the hotel rooms and they get the places just booked to the brim when the conventions are in town, especially during the week. And then the weekend, the regular gamble or the traveler tends to come in. Now, what management said at Caesars was they're seeing bookings up 32% versus 2019. Guess what we didn't have in 2019? Any virus. For the second half of 2021, which is kind of weird for convention traffic. Convention traffic for Vegas is typically from January till the end of the summertime. You got pool season, you've got, a reason to travel there during those times. Back half of the year, you see a little bit lighter convention traffic. Well, we're seeing that flipped. So a lot of conventions, ones that I regularly attend, are being scheduled for the second half of 2021. I think you're going to see a jam-packed convention season in Las Vegas, all things, going well with the virus and things like that. If all that progresses fine, you will have a jammed packed Las Vegas during the October, November, December months, which is actually kind of rare. So if things can really pick up and you get pool season going at Las Vegas could be in for a big turnaround. Now, the reason why we pay so much attention to convention traffic is the Las Vegas Strip saw a 44% decline in gaming when CES, the Consumer Electronics Show, went online this year. It's one of the largest shows in Las Vegas, brings in tens of thousands of people to the city and just books up the hotel rooms. And if you've ever been in Vegas during CES, which I have, it just the casino floor is packed. You'd be lucky to find anything other than maybe a $50 or $100 blackjack table open for you to play. So you better be some big bucks. Now, MGM is going to open key Las Vegas resorts 24/7 in March. Mandalay Bay, Park MGM, and the Mirage are set to open for 24/7. I think they've been closing like Monday through Thursday or something and then open during the week. Well, I think they're seeing enough demand where all the casinos in Las Vegas, or at least the ones on the Strip, appear to be open 24/7. So that's a little bit of the news. Catch you up with that. MGM reported earnings just a week or so ago. We're going to jump into them. Obviously, they're not going to be that great, but I think we can all understand why. For the 3 months ended here, 19 over 20. Take a look. Our casino take went from $1.6 billion all the way down to about $963 million. Obviously a massive decline, almost a 50% decline. But I think they're seeing the light at the end of the tunnel. You see rooms here, big decline. Everything across the board, big decline, except reimbursement costs, which might be like player comps or something like that. And we've got expenses here, what it cost to do those things. They're still making a lot of money on the casino floor. They spent $500 to make the 963. The rooms are really crushing it. They spent $97 to make $189. That's pretty decent margins. The food, they're basically breaking even on. They made a little bit of money in the previous year. Some of this stuff is to bring in the traffic and then obviously make a bunch of money through the rooms and the casino floor. All things considered, they had operating income of a negative $363 million. Last year, in just one quarter, they made $2.9 billion. So it just shows you when this company can kind of get back on its feet. And boy, when it was at $7, it was a pretty darn good value. But look, this company is still, this is a $19 billion company, and you're doing $2.9 billion through 12 months in a more normalized environment. You're doing, 3.9. That includes this big gain on this REIT transaction. So I think that what they did is they sold like the Bellagio and maybe another property to a big REIT investor, and they're basically leasing back the Bellagio from that investment or something like that. So that kind of skewed these net income numbers. I think you could almost subtract that out and get a better idea where this company is from an operating income perspective. But negative for the year at $642 million. Again, pretty much a disaster. But when you consider on the balance sheet, this company has about $5.1 billion in cash, another $300 in receivables. All things considered, not that bad from the balance sheet perspective. They've got a little bit of debt sitting here on the balance sheet, as you'd expect with these casino operators. Got about $12 billion, but it didn't balloon much from last year. You see December 31st, 19, we really only went from 11 up to 12. And so that's not really that bad. Now they have these operating lease liabilities that did tick up quite a bit in the quarter or over the last year, but all things considered, it's not that big of a disaster from a balance sheet perspective over at MGM. Now, the last thing I want to show you here is the net revenues, and they break it out. Las Vegas Strip, they have the regional operations, they have the MGM China, and they've got some other stuff here. You see here, the Strip has just been crushed for the last 3 months. They went from $1.4 billion down $1 billion. You see regional operations are holding up much better. Okay, we went from about 900 million down to about 600, so that should bounce back nicely. And MGM China also down as well. So they're big growth drivers like this MGM China and Las Vegas. I think we can consider could be as early as the summertime, not necessarily back up to 100%, but certainly back up more than where they were. Obviously, too, MGM's going to run into some really easy comps since they were closed for parts of last year in both China and Las Vegas, just straight up closed. So the comps are just going to look ridiculous when those come out later this year. Now, over the stock chart, stock's just been on an uptrend. Okay, we bottomed out here, or at least the uptrend started here on the end of January at about $28, and we bolted on about $9 to the share price, and it's up here at 37. I would just say, look, we could draw some lines in here on a pullback, but until this stock breaks this upper trend line that I've drawn in here, look, the uptrend is intact. Any pullback to this trend line has been a buying opportunity. Obviously, we're talking over, a couple weeks here, so it's not this like major long-term uptrend. But if you think this stock, if you want to go long this stock you want to buy, you want to get into the casino space, a pullback to this trend line is where I would first want to step in. Now, you break this trend line. This stock breaks this trend line, comes down. There's some levels here. The most prominent one here is sitting about $6 under where the stock is, about $31.50. You see we topped out here, topped out all through here. This was several months of topping out, 2 or 3 months. That to me would create not lots of buyers, but buyers would step in at the $31.50 mark. So if this stock were to break the uptrend, I could see it pulling back to that area, and that's where a spot where I think you definitely would want to get in on this one. Again, if you believe in the casino sector, you believe in MGM turning things around. That was MGM Resorts. Next company coming up next. Next stock we're going to take a look at today is Beyond Meat, ticker symbol BYND. Over the last year, stock's up about 30%. We got a $9.5 billion market cap. Has a considerable amount of short interest in this one, 17%. I know that's not like GameStop worthy, but it is relatively high. And this company is not printing large amounts of money to the bottom line. In fact, they're not really printing a lot of profit to the bottom line. So the PE is going to be a little inflated, but I don't think investors are really investing in this one to see that, earnings print on the revenue side. Now, speaking of big announcements, Beyond Meat reported earnings yesterday, and initially the stock was up big, about 13%, up to $162 per share, because Beyond Meat got in bed with McDonald's and Yum Brands. I can't think of two better companies. If you have a food product to sell and you want to sell it into food service, McDonald's and Yum Brands, which owns KFC, Pizza Hut, and Taco Bell, is definitely a great partnership. And I think, understandably, Beyond Meat stock was soaring. Now, the next day, the stock, you can see here, is down to about $145 per share, because the next day, McDonald's and Beyond Meat kind of had to come out and clarify some things. McDonald's in particular came out and said, well, we're working with Beyond Meat. They're going to be our preferred plant-based supplier for the McPlant burger, but our chains of restaurants are going to be able to use and work with other suppliers as well. And so that obviously had the market kind of selling off. But all in all, not necessarily that bad of news, but maybe not as glorious as it was when the numbers came across. So first thing we're going to do, jump into the numbers with Beyond Meat. We got 3 months ended here, 19 over 20. They break it out U.S., retail, and food service. And then they do the same thing in the international market as well. In the U.S., we've got this retail, think like grocery store and things like that. So what happened over the last year is, obviously food service kind of fell back. Okay, a lot of restaurants were closed or closing. Going out to eat became difficult and challenging, whereas retail, like grocery stores, that business just like blew up. I mean, grocery stores probably had one of their best years of all time. And Beyond Meat did a smart thing at pivoting their product more in focusing more onto this retail. And you see here up 76% over the last year on a quarterly basis in retail, went from about 35 million up to 62 million. On the food service, what giveth taketh away from the food service. We were down 42%. And so we see here, though, U.S. net revenues were still up for the year about 25%, went from about 62 million up to about 77 million. Same story on the international side. International, fantastic growth on that food service side, went to up 140%, went from about 5.4 million up to about 13 million. But on the food service side, just got completely obliterated. The food service side on the international was their number one business last year. You see, it was higher than food service here in the United States. Sorry, retail in the United States was actually the highest business. So second highest business was food service international, and that got obliterated, down 62%. Okay, and we actually see here for the quarter, year over year, food service was actually down, total revenues down in the international was down 33%. Net revenues up fractionally, but basically flat. You see here up 3.5% from 98 to 101. For the full year, painting a similar story. Okay, I'll just come down here to net revenues. We see we're up 36%. So actually pretty solid, led, again, basically by these big, gigantic gains in retail. You see here food service in the United States actually off only 13%. It's interesting. It was all big in this quarter, okay, down 42%, but for the full year, only down 13%. So, it's a bad quarter, but for the full year, not really that bad for the food service side. So that generated 36% growth on that bottom line of the net revenues at $406 million. Now I want to slide down here through some lawyer talk and we'll get to the net revenues, because what this is going to do, now we're going to be able to take a look at the cost and see how profitable, or how, in a better case of Beyond Meat, how close to profitability they might be. So we pull down this net revenue side, and this is for the quarterly basis here. And then we've got year ended here. You see here, we pull down that 406 number. So this is our total revenues. And then we've got cost of goods sold here. We see here on the quarterly basis, We made $102 million. We spent about $76 million of that on the product. And so we gross out, that's roughly 25%. So they made $25.5 million. Now, this is not super, it's not like Adobe or Microsoft margins, but these are probably solid margins for a food product. We see here for the full year, similar story. Okay, we made $406 million, minus out this $284, and you gross out $122 million. Now, it's not the full story because we got research and development, and we got selling general administrative expenses. Now, these are likely not all cash. Some of this is stock-based compensation. Just keep that in mind as we're moving through these numbers. So we got all these. For the quarter, we spent $49 million on those other expenses. Remember that we grossed out $25 million. That means we have a nice little loss from operation at $24 million. Now, compared to the previous 3 months period where they lost they basically broke even at $927,000 loss. Obviously, things have gotten worse from the profit side at Beyond Meat. And so one could surmise that the shift into retail has destroyed profitability at Beyond Meat, because we see here for the full year, we lost $49 million, where in the previous year, we lost basically $500,000. They were on the verge of profitability in 2019, and then 2020 hit, and they had to shift their model into more retail and grocery, and it just blew up their profitability. So that is something that you want to keep in mind. The longer that happens, likely the longer Beyond Meat will not be profitable. Now, from a balance sheet perspective, not great, at least from a cash perspective. I don't want to say only, but for a company this size, they only got about $160 million in cash. And in the previous year, they had $275. So they had a fair amount more cash this time last year. And accounts receivable, about 35, about the same. Lots more inventory. I would guess that going into grocery requires you to have lots more inventory because they probably have better visibility into the food service side. Food service knows their inventory, knows what sells, whereas a grocery store, probably a little bit more of a guessing game. That's why you see like $40 million more in inventory. That does help your asset side, but if this is perishable, which it may or may not be, that could potentially be a problem. All things being considered, assets stayed relatively same. Now, what they did though is they actually cleaned up their balance sheet a little bit. We've got this long-term portion of a bank loan that disappeared. Okay, that absolutely disappeared. They also had this equipment loan, about $5 million, so that disappeared. I think that's going to explain most of this I don't want to say cash burn, but cash decline. I think some of it at least can be explained away right here, that they basically eliminated this. Take a look at this. Our total long-term liabilities went from 20 million down to 12. And so they wiped out a fair amount of that. Now, some of it got pushed into the current liabilities, went from 47 to 88, and you're like, whoa, where did that come from? Look, accounts payable went from 26, basically double, to 53 million. So that's interesting. It could be that the way food suppliers get paid could have shifted in the quarter. The other thing here, I see this short-term borrowing under a revolving credit facility. They didn't have that this year, and now that went all the way up to 25 million. Whether or not that's fully tapped, I'm not exactly sure, but they have added that. So current liabilities actually ticked up quite a bit, while our long-term liabilities ticked down quite a bit. Now, from a cash flow perspective, we pull down those net income numbers. Okay, we pull those down, and then we get to add back in things like stock-based compensation and some other stuff. This gives you a better sense of what kind of cash is flowing through the business. Not that bad. Okay, last year, pretty bad. $47 million loss on the cash flow side. This year, about 40. Okay, and then you see here they kind of cleaned up their balance sheet by, they had some debt issuance costs, but they extinguished some debt here. They repaid the revolving credit facility. They did some cleanup here, and in fact, money flowed out of the company on the financing side. So they tried to clean things up. Everything looks okay financially. Not saying this company is in any worry there. Now let's get over to the stock chart with Beyond Meat. I'm on a weekly view right here. It just gives us a big, broad view of Beyond Meat, and I think there is some longer-term kind of trend lines, areas of support and resistance for this one, which have been holding for a period of time. I've got got this level at 160 marked in because 160 appears to be when Beyond Meat blows up above 160. The stock wants to come all the way down. You see it did back here. I mean, it went from 160 all the way up to 238 and then all the way back down to 75. And then we kind of traded down there for a while, came up to 160, got rejected, came back down to 125. Then we came up to 160, blew through it, came up here to 196, came all the way back down here to 112. Same thing has happened recently in the last couple of weeks. The stock went all the way up to $220 a share, only to be rejected and then back down below $160 per share. So where would I want to get this one? Honestly, it's smack dab right in the middle of a range, or a little higher than that. 140 is probably right in the middle of a range that I have marked out here. 113 is an interesting spot. It acted as support here, a little bit of resistance along this line. So 113 is where, I think you could potentially step in there. Although, any break below that and kind of like the $60, $60, $70 is likely in play with Beyond Meat. How I would play this one, I'm not exactly sure. I think the way, say somebody was like, you have to buy Beyond Meat at some point in the next couple years. Well, look, I'd just wait. I'd wait to see how this Yum brand and McDonald's deal works. I think the sexiness is worn off a little bit on Beyond Meat. It used to be kind of like the EV stock, or like, it was like the thing that they let off on CNBC. Now they barely talk about Beyond Meat. And so, the market cap and the kind of attention on this company has kind of diminished a little bit over the years. So I don't think it's necessarily going to run away from you. And you see, I'm on a weekly chart, and this kind of maxed out to the full company history. When it does these big gigantic candles, well, the stock tends to come back down to earth. And so I'd wait for that time and wait to see what happens. I'd also want to see this food service come back, right? I want to see food service come back here in the United States, come back international. And here's the last point, maybe one of the most key points. We saw in the most recent quarter and the year, they had this push-pull relationship where, yes, they grew retail at the expense of food service. Well, what happens if the virus gets under control and people stop going to the grocery store as much and start going out to eat because they haven't really done that over the last year? Well, will we have the reverse effect with Beyond Meat, where their food service revenues start to go up at the expense of retail? And so I'd kind of almost want to see like that to harmonize a little bit before I'd want to jump in. Being early for these types of stocks, not necessarily the thing that you need to do. I think patience would be key with this one. That's Beyond Meat. Hopefully you guys enjoyed that one. Next company that we're going to take a look at right now is DropBox Incorporated, ticker symbol DBX. Over the last year, stock's up about 13%. Got about a $9 billion market cap on this one. A little bit of short interest, about 5%. And a P ratio of, I say only 17.81 forward PE. In a market where overinflated PEs are kind of the norm, this one actually is looking reasonably valued. And then when we get over the numbers, I think you're probably going to agree with that sentiment, but I'll let you decide on that one. Now, from a price to sales basis, this one's trading about 4.88 times sales, and we see historically compared to itself, it's actually not that bad. It's bottomed out at about 4 times sales several times over the last year, but it's peaked its head up over 6, almost 7 times sales over the last few years that this company has been public. So reasonably valued from a price to sales basis as well. Now, they are issuing some convertible senior notes, and they're raising to about $1.4 billion if the initial purchasers exercise all their options on this one. $1.28 billion on the low end. About $58 million of that is going to go to pay off these hedge note transactions. Now, they are going to repurchase about 200 million shares of the Class A stock at $23.18 per share. The rest of it is going to be used for general corporate purposes. Should be about $800 to $1 billion used for that. Now, the other thing that I noticed here is on February 12th, they reported earnings, or right around there, and they decided to repurchase an additional $1 billion of Class A common stock. So they're going to do this $200 million here, and they're going to do another $1 billion here. So you've got that kind of tailwind with Box. that they are going to have a tailwind in terms of the share buyback. Now, let's jump over to the numbers here. We've got 3 months ended here, 12 months ended here. These are pretty much hot off the press, just a week old or so. We've got revenue up here, and we see revenue growing kind of nicely. We went from $446 million in the quarter up to $504 for the full year. We went from $1.6 billion up to very close to $2 billion. Now, the cost of revenue, this is a juicy high margin business. I love these type of businesses, and when you can get them at a reasonable valuation, I kind of like that too. Gross profit, $400 million in the quarter. Look, make $400 million off 504. Boy, most companies would absolutely dream of that. For the full year, we made $1.5 billion off of $1.9 billion in revenue. Just absolutely phenomenal margins. Take a look. You know, we grew the top line from 1.6 to 1.9, but our cost of revenue barely moved. It went from 411 up to 414. That's basically a rounding error. So if this company if you believe this company continued to grow these revenues, even at a relatively modest pace, well, look, they're going to be very, very profitable, at least from a gross profit perspective. Now, let's take a look at operating expenses. We got R&D, sales and marketing, general and administrative. We see during the last year on a quarterly basis, they're basically flat, if not down. That is a tremendous sign as well. And we see here for the full year, paints a very similar story as well. Now, there is some share-based compensation baked into these numbers, not all cash, but like I always say here on the channel, whether you're going to pay them in DropBox shares or cash or Bitcoin or whatever it is, well, it's got to get recognized one way or another. People are not going to work for free. Now, what you will see here on the operations side is this impairment related to real estate assets. And I read through this. Dropbox, like many companies, are going to a remote environment for most of their employees. That should actually help costs, but unfortunately, they have a big office building that they're going to convert to some office space where they will house some of their employees and maybe do some team building activities, but it is so big that they're going to have to sublease part of that building, and they had to take an impairment charge based on that. And that's where we see this big, about $400 million charge that they had to recognize on their operations. That totally blew up their total operating expenses. You see here, we went from 347 last year all the way up to 744. But again, most of that, actually over half of that, is this impairment related to that real estate kind of work from home environment. Same thing happened for the full year. It just blew up their expenses, and that killed their loss from operations, killed their EPS, killed their net income, killed all that, which some investors could be paying attention to. And we see here they swung to a big, gigantic $346 million loss. But if you want to factor in that most of that was related to real estate and kind of the virus, well, all in all, it wasn't a bad year at all. Notice that they lost about $6 million in the previous year, and they would have swung to a relatively generous profit this year, all things being equal. Now, like that, things are looking pretty good from the operation side. Now, from the asset side, sorry, the formatting on this is a little funky, but we'll do what we can. Cash and cash equivalents looking pretty solid. Now, it did go down, but some of it got flowed into the short-term investment. All in all, they got about $1.1 billion. That's about where they were last year on that side. On the liability side, not a whole lot going on here. They got a little bit of liabilities, but only about $2 billion. They could cover that with almost all their cash. Now, from a cash flow perspective, we pulled down this negative number. So then the net loss, again, that is affected primarily by that real estate transaction that they had to do. This is the 3 month. Here's the full year, negative $256 million. But guess what we get to do on cash flows? We get to add back in that impairment on real estate. And then we see here that net cash provided by our operating activities ticked up to $570 million. Compared to last year, we're at $528. Just a steady business over at Dropbox. Okay, not going to be one of these high-flying stocks, and I actually think stocks like this are probably underappreciated in today's market. When you have stocks like Tesla and GameStop and Bitcoin and all this stuff that is just going up by astronomical percentages on a monthly basis, sometimes a daily and a weekly basis, stocks like Dropbox tend to get tossed out into the cold, and that is potentially why the executives and the board of directors believe that the shares are undervalued and why they're doing aggressive buyback of the stock. Now, let's go to the stock chart. This one has channeled up, and it's in the top, it kind of had, like most stocks, it kind of sold off. We had some big sell-offs. It kind of drifted down, and now we're up here. We're kind of in a sideways consolidation range between about $21.50 and all the way up to about $25 per share. We're sitting right here at about $22 per share. I don't mind this one. If you want to get into this one from a valuation perspective, from a gross margin perspective, this one is checking all the box. From a tailwind of a share buyback perspective, checking more box there. Oh, this is what I would say about DropBox. It's one of those companies that I think is probably better off being acquired because the market is not giving them a big multiple on their earnings. The market doesn't give them a massive multiple on their sales. Personally, I think this company would be better off being purchased by, I don't necessarily want to throw out names, but you could think of them. Maybe a Salesforce, maybe a Google, maybe a Microsoft, maybe another tech company out there that wants to bolt on some just really good profits onto the company. Whether or not the company wants to do that, whether the board of directors and the founders of this company want to do that is another story, but I think that could be a generous outcome. If you can get this stock at a low price, your upside in this one could be the share buyback drives up the price even more, but I think a competitive bid by somebody in this space could drive this one up. But again, that limits your upside. When a company like Microsoft comes in, or Google, or any company that could potentially want to acquire a company like this, it would limit your upside because your upside is capped at whatever the business is valued at the time of the acquisition. Whereas when you think about a Tesla or a Bitcoin, the upside seems almost unlimited right now. And so those are things that you want to factor in on this one. But from a valuation perspective, from a gross margin perspective, this company looks good. If you're in this one and you want to add to it, I would have absolutely no problem with it. I would just keep your expectations in check on this one, likely not to soar to the upside like you see other tech stocks out there. And if it were to soar to the upside, I think it would be on a buyout news, and that's where DropBox is. So there you go. That was DBX. On to our next company. Next stock we're going to take a look at is DraftKings Incorporated, ticker symbol DKNG. Year to date, the stock's up 32%. We got a $22 billion market cap on this one, a little about 5% short interest on this one. They just reported their numbers. It's kind of interesting. I think they did a nice job kind of explaining why they had a nice little guidance beat due to certain factors. So first of all, they had external factors. There was a favorable sports calendar, especially in the NBA and college sports. And then you also had expansion of the Illinois mobile registration, which I think just started to accept betting. They said that they also had atypical, I think OSB stands for on-site betting hold percentage, so about $30 million, and that is typically atypical for bookmakers, it seems like, in this space. They say particularly in NFL and college football. I think it says two things. Either DraftKings has more favorable lines for them, the bookie, or that their bettors are maybe less sophisticated and they're able to hold a larger percentage of the take. Which one is true? I'm not exactly sure. Stronger than anticipated business performance as well. Obviously, we're seeing markets open up for these guys. The Tennessee market came in and that was, better than expected. There was also some marketing. So they had anticipated about $550 million in revenue. They ended up making about $644 million. So we're going to jump over the numbers, take a look at what's going on here. We've got the last 3 months ended here 19/20. We're going to focus mainly on this most recent quarter because DraftKings business is changing so much. And we also know that in the beginning of 2020, we saw the cancellation of March Madness, which would have been a big betting thing, probably even the Masters at the same time. Obviously, the NBA season got put on hold for a long period of time as well. And also baseball had a shortened season as well. So it really screwed with their calendar. 2020, more normalized calendar in the back half here with NFL football and obviously the NBA starting their season. While they started it a little bit late, you probably had strong betting in there. So we had a revenue coming in at a $322 million cost of revenue, not a particularly high margin business. Okay. They spent about $160 to make that $322. But they also have sales and marketing costs. astronomical at nearly $200 million. Okay, add these two costs up and you're over what we did in revenue. We also have product and technology coming in at $66 million and general and administrative coming in at $173. That gives us a loss from operation at $268 million. So this company is losing quite a bit of money. And you see here for the full year, same story. I don't necessarily think investors are betting on this company for the current time. They're really betting on them capturing a large portion of the sports betting market, not only from a daily fantasy perspective, but I think more increasingly from just a traditional sports betting market, whether it's in person or online. DraftKings is well positioned there, as any company, including casino operators like MGM and even Caesars out there. Now, they do some adjustments down here. If people comment on the channel, why don't I look at adjusted numbers? We'll take a look at what the biggest adjustment is stock-based compensation. And look, I know stock-based compensation is not cash flowing out of DraftKings balance sheet, but how are you going to pay the employees of DraftKings? Are you going to pay them in stock? Or are you going to pay them in dollar bills? They're basically the same thing. So from adjusted basis, look, the company only lost about $87 million. That's still tenfold increase over the previous year's period, but those are things that you can decide if you want to factor in or not. I tend to just look at net loss in this case, or in this case, really just the operating loss is sitting at $268 million. In the previous period, we lost 31. So this is a company that is not even close, in my opinion, to profitability. They're probably I would guess several quarters, if not several years away from that. Now, does that mean that you shouldn't invest in the stock? Well, again, that's really your decision. It has been in a nice little uptrend here for the last several months or so, and now we're kind of caught up in here near the all-time highs. I believe these are the all-time highs for DraftKings, right around $64, or at least more recent highs. This goes back to about October of last year. We see here the stock did pop up very briefly above these all-time highs, got close to about $65 per share, and got rejected and all the way down to about $56 per share. Currently, we're sitting at about $61 per share. How do you play this? Two ways you can play this. You can wait for a pullback down here to 56. Even more significant is probably this 55 area. It was a top here, and it was a top here, and it was kind of a launching point here as well. So I kind of like this 55 area. Now, the other scenario is that we could come back up here to 64, and we could break out, and we could break out hard, and this thing could run back above and make new all-time highs. And you might be sitting around saying, well, I should buy now just in case it does that. Well, here's another way to think about it. If this stock does break up above 65 and we get nice strong confirmation and this stock heads above, well, look, 64 now all of it becomes a support level instead of resistance. And so I don't mind as a shareholder if I miss a move, even if it's only $5, $6, $7 in the stock and this thing kind of pops up here. Well, that confirms to me that there are buyers of this stock and they're showing up. And if this thing pulls back down to 64, well, that could be my next entry point and I can do it with confidence. Whereas right now, if I buy in here at this $64, $65 level, I'm kind of worried that it could get rejected and get sent back all the way again down here to 57, 55. That's just kind of how I see this one. When you're betting on DraftKings, pun intended, I guess, you're really betting on increasing of this sports betting market expanding here in the United States. I think you've got some markets that have opened up. You've got Michigan, Virginia, Illinois. More recently, it appears you've got on-site betting in 12 states. Okay, there's 50, and we know there are certain states in the United States that just will never get sports betting, or even if they do, it's not going to be that big of a business, because there's just not that many people in those states. And really the home run states are Florida, Texas, and obviously out here in California. If California were to launch some sports betting initiatives, you better believe the Indian casinos would be a part of that and would take a large amount of that revenue. And whether or not DraftKings could sneak into what would likely be the largest market would probably be debatable at best. So you're betting on industry growth. You're betting on government regulation. Those are tough things to bet on. And so in my book, DraftKings is a speculative stock. It is kind of a fun one to invest in. quite frankly, you might be better off just using the platform, maybe betting on some sports or doing some daily fantasy. That could potentially be as profitable as this stock because we've got a $22 billion valuation. And again, the stock makes very little money. In fact, it loses quite a bit of money. And when we're talking about this type of revenue, $300 million in a quarter, that is not that much considering we have a $22 billion valuation on this one. So I like this company. I like their product. I like that the market that they're in, whether or not they are going to get a pole position and be a market leader over and above an MGM, over and above a Caesars, over and above any other betting platform that's out there, I think is still debatable. And whether or not they can penetrate the largest markets like California and some of the other high population states out there is also debatable as well. That is tough for me to predict as a shareholder. So I think the performance of this stock will be difficult to predict in the long run. But in the short run, stock's up. And if you've been holding this one, you've probably done well with it. So that was DraftKings. On to our next stock. Next company that we're going to talk about today is Take-Two Interactive Software, better known as Take-Two, ticker symbol TTWO. This stock, like you can imagine, like a lot of video game stocks, not quite like GameStop, but this stock has been on fire over the last year, up 68%. We've ballooned to a $20 billion market cap on this one, but the PE has stayed relatively low when compared to some stocks out there at 29. We'll talk more about valuation here in a minute, but I want to talk about Take-Two and their dominant just revenue position and just a dominant position that they have in the video game market, and that should be well served as the new consoles get in the hands of more and more consumers. We see here revenue trend just up in a straight line. I think what's even more impressive is the cash flow generating machine that this company is. You see here capital expenditures are in this kind of like greenish box, and this is the net cash from operating activities. Just gigantic cash flows off of a relatively low capital expenditure. They're really just recycling hits and just hitting home runs time and time again. I think Grand Theft Auto 5 is the greatest example of this. That game came out before I think I was married and had kids, which seems like so long ago, but it is still one of the best performing video games every single year. It is absolutely phenomenal. The fact that they've been able, obviously they invest in it, they add new content and things like that, but it's definitely different than when I was a kid, when the very fresh game was what was hitting for most of these game makers. Now they can just recycle some hits time and time again and add content via an online method. Now let's look at the numbers and then we'll look at valuation, and then finally we'll jump over the stock chart. This one has pulled back considerably over the last few weeks and months, and boy, we've gotten in a really nice defined downtrend. We'll see if there's a little spot here where we can pick this one up if you want to jump in on this one. Now, so we've got the 3 months ended here in December and the 9 months ended here. So they have one more quarter to go kind of for their full year. We see here net revenue for the quarter was actually down from last year. It came in at 860 million. We're actually 930 in the previous year. Not a lot of explanation for that. Maybe a little bit different video game cycle. Maybe people are more into the new consoles, which have less games available for them from Take-Two Interactive, at least at the current time. We see for the full year, though, the trend is strong. $2.3 billion up to $2.5 billion. That's not the full story. What I want to take a look at is our total cost of goods down here. Take a look. Yes, we saw revenues decline kind of marginally, but we see our total cost of goods sold also declined, I would say more significantly. We went down from $437 million all the way down to $346 million. What does that do to our gross profit? So our revenues declined, but our gross profit increased. We went from 493 up to call that 515. That's a pretty strong increase when you consider our revenues did decline during the quarter. Now, for the full year, paints a similar story. We went from $1.1 billion in gross profit up to about $1.3 billion in gross profit. Now, we've got some other costs here as well: selling and marketing, general administrative, research and development. They throw depreciation and amortization in here as well. We've got our total operating expenses here coming in at $338 million. They were slightly lower in the previous year when we had higher revenues. And so that gives us income from operations basically flat. We went from 176.8 to about 176.1. So basically flat year over year on a quarterly basis on that income from operations. We see for the full year ticked up slightly from 303 up to 337. All things considered, pretty strong. I think investors probably wanted a little bit more on this top line, and they're seeing year over year declines, and that could be scaring some investors out, maybe thinking that they're going to come into some really tough comps in Q1, Q2, Q3 as they move into next year. That probably has some investors worried. Now, from a valuation perspective, these companies have always traded at a slight premium to the general market, but I have compared on here. Take-Two Interactive is the orange line. EA Sports, Electronic Arts, is the blue line. They make similar games, although nobody can compare game maker to game maker, but these two companies are relatively similar. And we see right now, they're actually trading at a pretty close price. This is price to sales basis. They're trading about 6 times. Now, both of them have been as high as 7, even 8, and almost close to 9 times sales. So they've pulled back a little bit from where they have historically. I think you'd really love to get them down close to 4 times sales. Whether or not you get an opportunity at that, I am not exactly sure. Now, from a price to earnings basis, again, they both typically trade at a premium to the overall general market because they have strong margins. It's a strong trend as well with video games. I don't think it's going to go anywhere as well. Now, Take-Two's in the orange line, Electronic Arts is in the blue line. Take-Two has always traded at a premium to EA, although they've gotten close here in the past, and they're actually pretty close right now. Take-Two's trading about 43 times trailing earnings, and EA is trading at about 33. I think if these come back a little bit, could be a buying opportunity. We see here back in 2018, both these companies were trading up, 70, 80 times forward or trailing 12 months earnings. So from a valuation perspective, not that bad considering how far these stocks have run and what a great, segment the video game sector has been in. Not that bad. They basically have grown their earnings and they're kind of grown into a multiple, so to speak. Now, moving over to the stock chart, this stock is in a downtrend. We see here, we kind of peaked out here. This was back in February 8th. We kind of peaked up here at we'll call that $215 per share. And we have slid down all the way down to about $185 per share, which is where the stock is trading right now. It has not really gotten above this trend line. I see a pretty strong area of support approaching for this stock. We'll call it right at $175 per share. So really only about, I'd say about $10, $10 where the stock is today. We see here, it was a really significant area of resistance here. And then it came back in here, was resistance again. Once you broke 175, boy, it was off to the races, up about, $40 up to the 215 range. And now we've retraced almost all the way back to it. So I would actually consider this level to be a key area of support. If Take-Two were to blow past this area, I think it could create significant buying opportunities down here in the 150 range. Whether or not it gets to that point will depend on probably the overall market, but market sentiment as well. And Take-Two sentiment is as follows. So I like this stock. I like this company. I like their games. I'm not necessarily a video game player. I haven't played video games in a long time, but I'm familiar with these guys' products. I have played their products in the past. I think they have an extraordinarily strong offering, and I believe it to be able to continue as we cycle into the new consoles. And maybe do a Google search, when is Grand Theft Auto 6 coming out? Because that should be a catalyst in the future as well for a company like this. Although Grand Theft Auto 2 and Red Dead Redemption 2, which have been out for many, many, many years at this point, still just generating massive amounts of profit and sales for this company. So we're pulling back into that zone. I like Take-Two. I love the CEO. I think Strauss Zelnick is his name. Just a legend in the industry. Well-run company. Has pulled forward a fair amount of gains, but they kind of grew into this multiple, and any deeper pullback in this one, and I think it can be a buying opportunity for you out there. So that's Take-Two Interactive. Next company that we're going to talk about is Lyft Incorporated, ticker symbol LYFT. Obviously, along with Uber, probably one of the largest kind of ride-hailing apps in the world. Over the last year, the stock's actually done well, up 40%. Got an $18 billion market cap in this one. Some short interest in this one. About 9% of the float looks like it's short. And I'll show you why. When we jump into the financials, there is very, very good case to be short this stock. But then what's interesting about this stock, and this happens occasionally here on the channel, from a fundamental perspective, this company has some struggles, but from a chart perspective, oh my goodness, this thing is looking really good. So we'll come back to that in a second. First thing I wanted to show you here is from a valuation perspective. Price to sales. Uber, Lyft basically make money the exact same way. I know Uber's got like Uber Eats and some other stuff, but they're basically paying, per mile, per ride type of thing, whether they're transporting food or people. It really doesn't matter too much. We see Uber gets a small multiple over Lyft. They're about 8 times sales. Lyft sitting at 7.35. But what I wanted to point out for you is over the last 3 years, we are basically at an all-time high, at least with Lyft. Uber's been a little bit higher, been closer to 10 times sales, but Lyft is basically as high as it's ever been price to sales. Whether or not you want to step in here and buy this company at a premium multiple, at least to sales, I'll let you decide if you want to do that. Now, Uber slips as the UK drivers wake up as employees, not contractors. Obviously, we saw out here in California, there was a proposition on the ballot, and me being out here in California, I had a strong feeling that that was going to get shot down. Sure enough, it was, but the two companies did agree to give 30 cents a mile driven to employees of or contractors of Lyft and Uber. And they also, anybody that works over 15 hours or more per week get a little bit of incident coverage and in health insurance benefits as well. So this will likely spread throughout the world. And I think this is a complete and utter strong headwind for both Uber and Lyft as they move forward in the years in their business. It's just some countries are going to treat their employees or their drivers as employees. Some places, some states, some governments are going to treat them as independent contractors, but potentially force them to compensate them more than they were or want to. So it's just a headwind in terms of that. Until you get kind of full self-driving, then maybe that opens up the door for these companies, but then it could open the door up for like a Tesla, which has the self-driving capabilities that neither of these companies have. Let's jump over to the fundamentals here. We'll take a look at revenue and profits here at Lyft. Spoiler alert, there's not any profits, but what I do like here is they give us a year-ended view, basically 3 years in a row, because it was a tough comp between 2020 and 2019. As you guys know, the virus infected basically the entire world and ended a fair amount of the ride sharing that was going on. We see revenue slid to 2.3 billion, down from 3.6, but it's comparable to 2018. So Lyft is basically taken 2 steps back to 2018 in terms of revenue. Now our cost of revenue slid year over year, and it's comparable to where we were in 2018. Now what isn't comparable is a lot of our other expenses have taken a big jump, especially over the last 2 years. Year over year, not as much, but we see our total cost and expense line right here came in at $4.1 billion. That's $1 billion over where we were in 2018, and it's off from 2019, which I think is understandable. But when you spend $4.1 billion and you bring in $2.3 billion, guess what's going to happen? You're going to lose just a light $1.8 billion running the business. So they are miles and miles away from turning a profit over at Lyft. You see in the previous year, they lost $2.7 billion. So even if they had a good year sales-wise at Lyft, I don't think they would have been anywhere close to churning out a profit. Now, you're going to say, some of you are going to say, look, there's some stock-based compensation in there. Yeah, you're right. There is stock-based compensation in there, but guess what? It's actually not that much. It's only about $565 million. When you pull down a net loss here, we're in 2020 here, we pull down that net loss of $1.7 billion. We'll get to add back in some depreciation and stock-based compensation. Those are the two big numbers here. Well, guess what? We still lost $1.3 billion, basically $1.4 billion net cash flowing out of the business based on operating activities. Notice last year we were negative by 105. In the year before that, which is kind of comparable to 2020 in terms of revenue, we only burned through $280 million. This company just lit a bunch of money on fire in 2020. So they better hope things turn around very quickly. Now we'll zoom up here to the balance sheet. They kind of led with this. We do have some short-term investments here, about $2 billion, another $300 million in cash. Blended together, you got about $2.5 billion in cash. They did bolt on some long-term debt at this company at about $600 million. Tell you what, if you burn through the same type of cash that you did this year, they're probably going to have to do something on the balance sheet in terms of either raising more money, whether it's through an equity offering, convertible note, or just traditional debt financing. Lyft is probably going to have to do some of that heading into this year. But guess what? Guess who doesn't care? The stock market and shareholders. This stock has been on absolute fire. I'm on a weekly time frame here, so we get the entire view of Lyft being a public company here. And so this low here that we made back in October was at about $21 per share, and this stock is more than doubled over the time frame to today's date, where we're sitting at about $55, almost $56 per share. It has been locked up into this uptrend, and what I personally see, this is one of those weird cases where fundamentally I would not want to touch this company. They are burning through cash. They don't have a lot of cash. They don't have a market leading position, and you've also kind of got this government kind of employee versus independent contractor headwind. On top of that, you have the work from home thing, which looks like it's likely to stay. You see mass people fleeing from San Francisco and New York, some of its largest markets. Overall, everything looks like a disaster, except when you get over to the stock chart. This stock is on a choo-choo train up to 68. In fact, I would be somewhat surprised if this stock doesn't retest these highs that we made back here. This is like July of 2018, August of 2018, we kind of made these highs back here of 68. You see here, we made some highs back up in here. This was last year in February. Like most stocks, this thing absolutely went in the dumpster. Once we broke these highs, which were right around $50 per share, we actually broke it on this solid green candle. Well, it was up here to the races. And quite frankly, I think we retest these highs up here at 68 on Lyft. So if you want to trade this one, I think you got $13 in upside. I think you could set your stop loss somewhere on a trend line here, maybe $50 per share, $55 per share. I think you could come down here $5 under the stock, set a stop loss. There's actually should get some support. If this stock sells off to 55, you've got some consolidation of price here. That would actually be, an area where you should see some support with this one. So you could do a stop loss down there if you wanted to. I think it would bounce actually if it got down there. And you've got $13 in upside. Not the best risk reward in terms of trades that I've seen over the last couple of weeks doing these videos. But look, this one's definitely set up nicely. So this is one of those weird things. If you're an investor and you're from a fundamental perspective, I wouldn't touch Lyft. Wouldn't even think about it. I don't think it's a buy and hold investment. I just don't see anything here for the shareholder that looks good. But from a trading perspective, from a chart, from a technical perspective, this thing looks okay to me. So depending on how you want to play it, there we go. Over the last year, up 40% in Lyft, and I actually see further upside continuing for this one. So that was Lyft. Interesting stock. One of those kind of like interesting paradoxes where we have two tales of two different tapes. You decide which way you want to go on that one. I'll tell you the way I'm going to go on it. I'm not going to touch this company. I'm a buy and hold investor. This one doesn't look like to me to be singing those songs. Hopefully you guys enjoyed this one. Next company is coming up next. Next company that we're going to take a look at today is the Coca-Cola Company, ticker symbol KO. Actually, one of the first companies I did a video here on the channel many years ago. Over the last year, stock's down about 15%, $210 billion market cap, very little short interest, in part because they do pay a dividend, and it's not that bad, 3.4% yield on the dividend rate. You get about $1.68 per share. Now, what's interesting is, speaking of the dividend, they just lifted it a penny. Most of these companies that have been paying dividends for a long time and increasing them for a long time, which is Coca-Cola, they usually get to the point where they're lifting them up a penny. When we jump into the numbers, we'll see how financially healthy Coca-Cola is, and then we'll jump over the stock chart as well and see what's going on there. Now, Coca-Cola is moving to take a controlling stake in Body Armor, which is a drink they already have kind of a minority stake in that they took in 2018. That's Coca-Cola's playbook these days, is they take minority stakes to do little investments in kind of startup brands, startup drinks, and then as they grow, they look to kind of acquire a controlling stake. I actually think it's a great strategy, and I think it's a strategy that they'll likely execute going forward. Now, what's interesting is inside their most recent earnings report is they have this deal with the IRS, and I don't want to say it's a deal. The United States tax court says that they owe them a little bit more money, and by a little bit, I mean a lot. That Coca-Cola is estimating that they could have a total liability of $12 billion. That is what they be inclusive of interest accrued. This is based on some U.S. tax laws that the United States tax, the IRS, believes that Coca-Cola owes, and Coca-Cola believes that they don't owe. Whether or not, how this turns out, how this plays out, I don't know, but I know that if they are forced to fork over $12 billion, that's a lot, and I don't know if that is fully priced into the stock. My guess is this is priced into the stock a little bit. So once you see resolution in this, then the stock will likely move one way or another. And I don't necessarily think it's going to be a violent move, but I don't think $12 billion is priced all the way into the stock either direction. So if they don't have to pay $12 billion, the stock will probably react positively. If they have to pay anywhere close to $12 billion, my guess is you'll see a negative reaction. When we get over to the balance sheet, I'll show you more about that. Why? Now, for the 3 months ended here, we've got 19/20. We'll look at the 3 months and the year end here with Coca-Cola in terms of revenue and the profit. We've got our net operating revenue here. We see it's down 5% for the year. It actually was a good quarter. When we come over to the year-end view, you'll see why. Our cost of goods sold, basically flat. Just a company this old and this mature, you'd actually expect that to have just a well-oiled machine, even in the environment that we're in that's kind of difficult for most businesses. A business like Coca-Cola just has their cost structure just in lockstep. We see, though, gross profit ticked down from 5.5 down to about 5. You'd expect that when your operating revenues decline this much. So we saw gross profit actually decline about 9%. But what was nice was Coca-Cola controlled all their other costs. We see their SG&A cost here went down 20%. Okay. And so you guessed it, operating income right here actually rose. So while we saw our revenues decline 5%, gross profit declined 9%, because we cut these other costs by 20%, we actually saw an 8% increase in our operating income from 2.1 up to $2.3 billion. Now, they've got some other expenses here, and you come down here to the net income line. When a company does pay dividend, I do tend to look at earnings per share down here. We earned 34 cents. This is a company that pays $1.68 for the whole year, so it's right there on the edge in terms of dividend coverage. Let's look for the full year. We'll get a little bit better view of that. We see operating revenues came down 11% for the full year. Cost of goods, though, came down 8%. Gross profit down 14% from $22 billion down to about, we'll call that 20. Now, same thing happened here. We reduced our selling general administrative costs by about 20%. But our operating income, it just was not able to overcome kind of the operating revenues that we saw. So our operating income was down 20% in the year. Now, flow through some other things here, and we get down to diluted income per share at $1.79 for the whole year. Again, I told you that this company pays $1.68. So they're right there on the edge, okay? You know, if you have some negative impact into Coca-Cola's business, I wouldn't say that the dividend would be, unsafe, but in the long run, they are going to have to start growing this earnings per share. How they decide to do that, whether it's through cutting cost or just bolting on more revenue, either through acquisitions or other ways, maybe price increases or something like that. We'll see what happens. Now, coming over to the balance sheet, I talked about how they could potentially have this $12 billion liability. Well, take a look here. We got 6.7 on the balance sheet, another 1.7 back of the envelope math, and you're about $8-9 billion there. Okay, so that wouldn't be good. Now, we do have these marketable securities sitting here as well, so you can bolt those in there, but that would $12 billion would basically just wipe out almost all of the assets that Coca-Cola holds in cash. You see here, for just total current assets, they have $19 billion. Now, I'm not a tax guy. I don't work for the IRS, nor would I want to. I wouldn't imagine that Coca-Cola would have to write a check all in one day, and chances are, if they have good tax lawyers, which I imagine they do, they probably could settle out of these types of things. So we'll see what happens with this. But moving over to the liability side, we did see a large tick up in our long-term debt. So it's interesting that our total assets really didn't do much, okay? Our total assets basically were flat year over year, but we see here that our long-term debt went up quite a bit. It went from $27 billion up to about $40 billion. And so I don't want to say that's a problem, but this is definitely a company that, that is definitely taking on more leverage, and in some cases hasn't really improved their balance sheet to a significant degree. So we'll see what happens going forward with Coca-Cola. Now, from a cash flow perspective, we also see kind of a degradation in their numbers, basically due to I would guess most of it is probably due to the virus. You had a lot of restaurants closed and things like that, which likely hurt Coca-Cola's business. You see, last year they earned about $10.4 billion in cash flows. This year down to about 9.8. Again, really healthy, but all things considered, these things will have to turn around. You would like to see this company turn back into growth mode. Now, moving over the stock chart, what's going on with this one? This thing has been sideways consolidation since, I'm on a weekly chart here. So this, where I'm at right here on the graph, this is back in April of 2020, just after most stocks had this big gigantic decline, and then they started to rebound. So we've really been in sideways consolidation between $41 per share and up to about $51 per share. Now, I know we've got this cluster here where we peaked up to close to $55 per share with Coca-Cola, but it got rejected. More precisely, since about August of last year, we have really been in a sideways range from about $48 per share up to about $51 per share. And you see right now, the stock is trading right at $49. You could, if you want to, step in here, but just knowing that your upside is probably back up here to 54, but more than likely back up to 51, your downside, you have, I would say, very significant level of support here on the stock at right about $48 per share, which is really only $1 underneath it. Now, the bear case scenario, this thing goes below 48 on a big candle, and all of a sudden it brings in this lower box, any price pullback into the $43, $44, even $45 range. Could be a much better buying opportunity. I wouldn't say safer, might not be the word, but I think you could come in here and buy this stock with more confidence, since this is where the stock settled right after kind of the initial kind of knee-jerk reaction most people had to the virus. The stock settled in this 44, 45, 46 region before resuming kind of an uptrend. And so which way Coca-Cola decides to go, I don't know, but I'm sure you guys can realize this is like one of those steady kind of buy and hold stocks. It's not going to have amazing returns like a tech company, but it's not going to necessarily crash and burn like maybe some of those stocks could potentially as well. So that's the Coca-Cola company. Hopefully you guys enjoyed this one. Next company that we're going to take a look at is Rocket Companies, better known as Rocket Mortgage, ticker symbol RKT. The stock had a bombastic earnings report, and I think that was buoyed by the company declared at a $1.11 dividend per share. And then when we get over the stock chart, that just sent the stock soaring. It was at about $20 per share. It initially peaked up all the way to about $23 per share, settled at about $22 per share. We get over the stock chart. The stock is making a very interesting pattern, And we'll talk about what that might mean if you want to invest in this company. Now, Rocket Mortgage, if you're not familiar, it originates some of its business from originating loans, but gets the vast majority of its business through refinancing. And so you'd have to be living under a rock to realize that I think the 30-year treasury yields have been soaring recently. And so it's likely going to raise interest rates. In a rising rate interest rate environment, it's going to be a little more challenging for Rocket Mortgage to capture a lot of that refi business, but I'll tell you what, there's a lot of arguments I've heard on both sides saying that interest rates are too high, they're going to go lower, and they're going to go much lower. And then you have the other camp that's saying inflation's coming and interest rates are going to continue to rise. Which one is right? I don't know. I just want you to make you aware. You have some interest rate risk when it comes to a company like Rocket Mortgage. Will they still be able to refi at higher rates? Sure. But when rates are super low, the business, as we can see here, is just absolutely phenomenal. Now, so they've got these gains on these sales of loans here. They originate them and then they sell them, and they got about $4.2 billion of that. They have some service fee income here as well. That ends up coming out as a negative $80 million. They have some interest income as well from some money that they hold and things like that. That's about $14.68 million. Now they have this other income too. They're doing car loans. They're doing other types of insurance and things like that. So they are this is really healthy growth. And I think you'd like to see that as a company, that they continue to open up more and more lines of business. So we get down to this total revenue here, about $4.7 billion, up huge. Okay. This company was doing $2 billion last year. Take a look for the full year, $5 billion, tripled it to $15 billion. So let's take a look at the cost structure and see what's going on here. So they have all these other costs that they have associated with running the business. Total expenses for the quarter came in at $1.8 billion. So you minus that from the 4.7 and you get down to income before taxes at $2.8 billion. This is the company that is worth $43 billion. We'll talk about some things a little bit more in a second here. Let's look for the full year here. Our total expenses came in at $6.2 billion. Again, we made that nice 15.7, and then we come down here, we made $10 billion. Now, we pay some income taxes, but there's also this net income attributable to a non-controlling interest. In fact, it's the vast majority of the business. And so a lot of this company, it appears the earnings are retained by a non-controlling interest to Rocket companies. And we come down here, net income attributable to Rocket companies at $140 million in the quarter. For the full year, you're sitting at right at $200 million. Now, we come down here. I think this is what got investors super excited. You see here, earnings per share for the Class A stock. They earned about $1.21 per share, diluted $1.09. For the full year, they made $1.77, diluted $1.76. This is what I think has investors so excited. Well, they declared this dividend of $1.11. So they're returning the vast majority of their earnings in the year back to shareholders. And I think that's what got this stock to react so nicely and so positive, although it is back up to a level, or it basically peaked up to a level where it was back in January. I have this graph marked out, or this chart marked out here with Rocket Company stock, and we've basically been trading in a range. This goes back to about August, September of last year. We've been trading between $20. Now it's dipped below here, all the way up to about $24, and it has peaked its head up above. But you notice the pattern that the stock is making. It goes on a run from $20 up to $24, and then has a gigantic sell-off. It comes up here. This time it went to about 23, sold off. Went back up to 23, sold off. This time went all the way back up to 24, and what do you know? It's sold off. And now here we are again, making our way back up. In fact, this candle almost came all the way back up to $23, $24, and now we're sitting here at 22. The variable now, though, is now investors, I don't know if they'll be expecting this special dividend, but there could be many investors that are anticipating this special dividend, and it could create a little bit more people that are willing to hold this stock. And my guess is one thing could happen is now we could find ourselves in the middle of this range. So we could put a line here, which was a top here and a top here, and where this stock looks like it wants to settle right here. But either way, this stock, in my opinion, is likely stuck in this range until it proves itself otherwise. You're stuck between 20 and 24. A dip down here into the $20, $19, $18 range for this stock. And it's probably a buy as it ticks back up over the $22, $23 range. It's probably a sell. And if you do want to hold it for the long term, you better hope that they continue to declare these $1.11 dividends, because at least in the shorter term, at least over the last 5, 6, 7 months of this stock, it has been stuck in this range. And so we also need to factor in that rates are rising, at least in the short term. If you think that is going to continue, you want to analyze this company from a refi perspective. How many people are going to want to refi if 30-year mortgage rates are 4 or maybe even closer to 5%? I don't know how many are willing to do that, considering most people that have bought a house over the last several years are probably under 4, maybe even in some cases under 3.5% on their mortgage. I know I bought a house several years ago. I'm at 3.5. So we'll see what happens. But there's also the other side of the argument where people think rates are going to have to go low and go much, much lower, that we're actually going to see deflation, not inflation. Not to turn this into a macro show, but I think if you see rates reverse and start going down, Rocket Company could be a sneaky buy, because their refi business will likely just continue to be on fire, which would lead to more special dividends, it appears, in the coming year ahead. So hopefully you guys enjoyed this one. Interesting company. There's more to this than meets the eye, because you have to factor in the macro environment with rates and things like that. And I think you almost have to make a prediction on which way those are going to go, depending on if you want to, you certainly could trade Rocket Mortgage, okay, as a stock. But if you're trying to buy and hold this one, I think you need to analyze where you think long-term interest rates, 30-year rates are going to be in a year from now. So hopefully you guys enjoyed this one. A little bit different analysis. Next stock we're going to take a look at today is Stamps.com, ticker symbol STMP. First here on the channel, over the last year, the stock's up about 23%, $3.3 billion market cap. A little bit of short interest in this one at 3%. Forward PE sitting around 25. Now, what's interesting about Stamps.com, they just reported their earnings. When we get into these numbers, spoiler alert, they're spectacular, to be honest with you. But I think a lot of people are kind of weighing that, okay, this last year, everybody shifted to e-commerce, or most people did, for a lot of their buying. And so obviously a company like Stamps.com benefited 2 ways, okay? Obviously, they were able to acquire more customers and a little bit cheaper. They had a decline in customer acquisition cost, I think, because there were e-commerce sellers out there that were like, oh my gosh, I need a place to buy my postage. And they naturally gravitated to Stamps.com. So it allowed them to acquire more customers at a cheaper rate than previous years. And I think what people are wondering is, as we head into 2021, things maybe get better, or hopefully get better. It's probably a better way to say it. Well, will e-commerce still be a big driver? Will it see these big increases? Will Stamps.com continue to benefit that? And then when we get over the stock chart, you can kind of see, well, people are almost kind of betting that maybe it won't. Okay, so we'll talk about the stock chart here in a second, but I want to jump into these numbers. From a fundamental perspective, this company is doing really, really good things. Okay, so we've got the 3 months ended here, 12 months over here, 19 over 20. Sorry, this thing's format. I hate companies that don't format things right. Stamps.com, if you're investor relation guys watching, clean this up. This is better for shareholders. But anyways, so we've got this service revenue for the quarter went from about, we'll call that 148 up to 195. They got a little bit of product revenue and a little bit of insurance revenue as well. Now they've got this cost of revenue here. You see here, they don't spend a lot. Okay. Total revenues for the quarter came in at 205. For the full year, 757 in terms of total revenues. Now we get down here to our total cost of these revenues. Look at this. We only spent $46 million to make 205. That means our gross profit's 160 on that. These are juicy margins. Notice our total revenues for the full year were 157 after these costs. Total cost of revenues came in at 178. Our gross profit on 757 is $579. Wow. Now let's take a look at their other operating expenses here. Okay. So our total operating expenses come in at $101 million. You take away from our gross profit. So our gross profit is here. That factors in our cost of these revenues. So 160 minus 101 gives us income from operations sitting at $58 million. That is big time up over last year during this quarter where we were sitting at $32 million. Now for the full year, we made this gross profit, and we'll call that 580. We minus the 380, and you guessed right, $198 million income from operations. That's only a little over $100 million over last year. This company grew their income from operations by nearly double over last year. So just a phenomenal year, as you can imagine. And that all flowed down after you factor in interest and taxes and things like that. It all flowed down here to the bottom line. This company earned on a diluted basis $9.37 per share. Just absolutely phenomenal. Now, from the balance sheet perspective, things might even look better when you factor in this balance sheet. Come on, investor relation guy, clean your thing up so we can get it all on one page. But we've got cash and cash equivalents sitting here at $443 million. Got a little bit in receivables, got some prepaid expenses. Our total assets coming in at $1.3 billion. And take a look at our total liabilities. $323 million. Okay. So this is extraordinary. And that's almost all in accounts payable or other liabilities, probably money that they owe, probably the post office, I would guess. Wow. This company is phenomenal from a balance sheet perspective and from a gross profit perspective, from an operating profit perspective, from a growth perspective. This company is like the Mike Trout of stocks right now. So what the heck is going on? Why is this stock all the way down here at 162? It was back here in November and then back there in the middle of last year in the summertime. So what this says to me, I'm going to zoom this chart out just so you get a better idea of what we're dealing with here. Man, you could spread this trend line here at 175. The stock's sitting at 182 right now. I drew a trend line in here right about 175. You could actually have backed it out to this peak right here, but it is at 175 is acted as support here, heavy support here. And I would guess based on these fundamentals, it's probably going to act as support again right here. So this one, in my opinion, from a fundamental perspective, definitely a buy. From a chart perspective, definitely a buy. Now, could it break 175? Abso-freaking-lutely. This thing could break 175. And I tell you what, if it does, it's look out below. So if you want, what I would personally do, if you want to be ultra safe, we bottomed out here back in June at about 166 or so. This one's setting up, in my opinion, really nicely. But just in case we're wrong, just in case anybody, the stocks can do whatever, okay? And so I think I would put a stop loss here at 169, which is like just a couple bucks. I mean, it's like $7-8 underneath where the stock is right now. I'd put a stop down here at 179, and I'd play this thing to get back at least to this level right here, 220. So you're looking at $40 in upside, like a $5 stop loss on this thing. And yeah, so you could play. And if it got back to here and it blew through it, yeah, you're coming back up here to 250, maybe even all the way back up to 280, where the stock topped out 3 different times last year as well. So ride the wave. When you look at this stock chart, what does it remind you of? Like a wave. And so if you want to buy and hold this stock, don't get any problem with that. But if you want to trade this one, I think it brings better opportunities. From a fundamentals perspective, I think you're insured or insulated a little bit. These fundamentals are so great and the balance sheet is so good that I think you could trade this one and you could kind of just trade a wave on this one. So I like stamps.com. I like the business that they're in. I think they will have a little bit of headwinds. They probably will have tough comps to beat this year, but e-commerce isn't going anywhere. It's going to grow year over year, no matter what. And so I like the business that they're in. This chart is setting up perfectly. These financials are about as good as they get. It is a smaller company, but there's enough here. It has small volume, so if you want to trade this thing, you do have to factor that in as well. So that was stamps.com. Interesting company that we have here. And that wraps it up for our epic stock recap show. Be sure to check out, obviously, my other videos. I have lots of videos coming in the coming weeks, but we also have lots of videos here as well. Consider subscribing. I'm sitting right at 78,000. I literally can't believe I have this many subscribers, but I'd love to get to that 100,000 mark so I can get a plaque and I can show my wife that all this hard work is starting to pay off. So please come here to the channel. Check out my other videos. If you have a friend that you think might like the channel, suggesting it to them as well would mean a lot to me. Thanks for tuning in. Really appreciate all your guys' support and suggestions for today's show. We'll be back again very soon. Good luck with your investments.